Hello viewers, welcome to Already Late. In a shocking development, Franklin Templeton Mutual Fund announced that it is voluntarily winding up six of its debt funds effective April 23rd, citing severe illiquidity and market dislocation due to the COVID-19 crisis. In this video, I will explain what happened at Franklin Templeton, why did it happen, what happens ahead after this. What should investors of these schemes do now that the schemes have been wound up? Will more schemes get impacted? What are the relief measures announced? What should an investor of mutual funds in general do after listening to this entire saga? Do watch it fully to get a complete understanding of the Franklin Templeton saga. The six funds that were wound up are Franklin India Low Duration Fund, Franklin India Dynamic Accrual Fund, Franklin India Credit Risk Fund, Franklin India Short Term Income Plan, Franklin India Ultra Short Bond Fund, and Franklin India Income Opportunities Fund. These funds together managed assets worth over rupees 25,000 crores on the day the winding up was announced. So why did this happen? To understand what really happened, we will first have to see the commonality in these funds. All these funds were managed individually by more than one fund manager, but had one fund manager in common across the schemes, Mr. Santosh Kamath. Mr. Kamath is known to have a knack of taking position in risky debentures with an objective of earning high yields. He has been following this philosophy over the years and as a result has earned higher returns for the investors of all these schemes. Over the last few months, because of the slowdown in the economy, the good times of the fund faded a bit with default by Vodafone Idea on 24th January 2020. It is important to know here that this was not the only mutual fund company to have invested in these debentures of Vodafone Idea. Many other schemes from other companies also faced similar problem. So why only these schemes are in so much trouble? To get a better understanding of this, let us look at some insights into the fund over the last 6 months. That is from October 2019 till 23rd April 2020, which was the winding down date. This chart that you see now shows the assets under management of the various funds over the last 6 months. The total assets under these funds came down from 52,268 crores on 31st October to almost half at 25,658 crore rupees. During the same period, the assets under similar schemes of all mutual funds fell by just 9.5% from 3,85,560 crores at the end of October to 3,48,820 crores, a total reduction of just 36,739 crore rupees. So it is very clear that Franklin Templeton has been the most affected in terms of outflows and redemptions from these schemes as compared to the industry peers. Further, most of these redemptions came in the months of March and April. This clearly indicates a pressure on the fund manager to arrange for cash to honor these redemption requests. In a normal scenario, every fund manager anticipates a certain level of redemption and keeps cash and cash equivalents in the fund accordingly. However, when the money required increases, the fund manager normally resorts to selling securities from the portfolio and convert it into cash, a normal practice. This is what the fund managers at Franklin Templeton would also have done. But with COVID-19 and the lockdown adding burden to the already slowing economy, most of these securities held in the portfolio dropped in value. The demand for all securities, including these, reduced, which meant losses for all investors. So the question is, was there an alternative? The alternative was to borrow money from bank for short period instead of selling securities at low prices. This is done if the fund manager finds the current value of the securities in the portfolio is not conducive for a sale. A fund manager is allowed to borrow 20% of the assets in normal scenarios, and this can be increased to 40% after taking SEBI's approval. The fund managers here did exactly the same, as they did not want to sell securities at a loss and were probably hopeful of a better valuation in times to come. In February and March, when the redemptions were highest, the fund manager resorted to borrowing, and the table here, which you see on the screen now, shows the same. The borrowings have been across the schemes, but of course in different proportions, in different magnitude. The entire period of March and April would definitely be traumatizing for the fund managers considering the redemptions. And by April 23rd, it was inevitable for them to decide on winding down. There wasn't a lot more which they could have borrowed, and also selling securities at lower prices would result in bigger losses to the investors. It was now to choose between two evils, and Franklin Templeton decided to wind down the scheme and face the wrath of the investors rather than book losses and allow investors to redeem lower values. The decision is probably made with the thought process that economy will improve when the lockdown ends and fiscal stimulus kicks in. And at that point of time, sell the securities at a higher price. Or wait till maturity of these securities, which they are holding in different portfolios, and make the payment to the investors from the maturity proceeds. In either case, the investor here has to be patient and wait. While we have understood that the increasing redemptions was the major reason behind winding up the scheme, it is equally important to know why were redemptions so high. Well, these funds have been extremely popular because Mr. Kamath has been delivering superior returns over a long period of time. A lot of advisors and distributors also use these high returns and advise their clients to invest money in these high return yielding schemes. Who wouldn't want to invest in a debt scheme that gives 8% plus returns consistently? Imagine returns without the risk of equity. It's a good situation to be in. But when things did not move as expected for a couple of months, clients, including the corporate ones, hit the panic button and moved out. That started the dominoes falling effect for all these schemes. Only if the clients understood the risk while investing, things would have been much different for Mr. Kamath and Franklin Templeton Mutual Fund. So what next? If you are an investor in these schemes, you have to be patient. You can get your investment back in a few months to a couple of years, depending on the maturity of the portfolio. Further, there could be delay or defaults by some companies, which may delay the return of a part of your investment or reduce your investment in value. This table that you see now gives you an indicative range of time frame when you can get your money back. As you can see, it might take anywhere from 6 months to 3 years depending on the scheme to get your money back. The value of your investment, however, can be tracked daily through the NAV, which will give you an idea if the company or any security has defaulted its payment to the fund house. The next thing to understand is whether the market regulator can intervene and do something about this. It is unlikely that any direct bailout package will be rolled out for the investors because mutual fund investments are subject to market risks. But to ensure more liquidity in the system, RBI today has announced 50,000 crore additional liquidity to the banks only to help mutual funds to borrow money to honor redemption requests. For the investors of schemes of the Franklin Templeton, unless we hear anything from the company, our status is as mentioned earlier: wait, patient, and be hopeful. Another question that arises here is that will this problem happen with any other AMC? It's highly unlikely given the additional relief provided by RBI. The situation is grim and a lot depends on the economic recovery from the COVID-19 pandemic. The issue currently is more about liquidity in the market and less about the credit risk. Post COVID-19, a lot will depend on how quick and strong does India emerge on the economic front. We also need to understand that this risk is limited to only these schemes of Franklin Templeton. It is highly likely that you are an investor in equity funds of Franklin, the likes of Prima and Blue Chip. There is no risk of any winding down of any of the equity schemes of Franklin Templeton, or for that matter, any other mutual funds. This winding down, due to the liquidity risk, can be looked upon as an isolated event. Finally, there was another side effect of the winding down of these schemes. Franklin Templeton has quite a few fund of funds which invest in different schemes of their own. Six of such fund of funds have invested in a couple of the six schemes that wound up. As a result, the value of these six fund of funds came down heavily after the April 23rd announcement of winding up of these schemes. The details of these schemes are on your screen as I speak right now. As you can see, of the six schemes, only Franklin India Dynamic Asset Allocation had a decent AUM of 877 crores. This scheme had invested 46% in the short-term income plan. This is as of 31st March. The NAV has dropped by almost 17% in this case. Again, if you are an investor in any of these schemes, my advice would be not to exit now, but wait to see recoveries from the wound up schemes. I hope after watching this, most of your questions about this crisis have been answered. If it did, please share it with the investor community friends of yours. If you have any more questions or feedback, please leave a comment and I will get back to you. Thank you for watching Already Late. Happy learning.